Hi, everybody. Good morning. Thank you all for joining. This is actually the first time we've been doing one of these on New York. We did one on did a webinar a couple months ago on Portugal. I'm sure some of you guys joined. I think the goal for us is kind of to talk a little bit about the market, what's been going on, how we're feeling about it. Some of the changes that have been going on since we started operating and acquiring in the city, and kind of where we see it going, and both in terms of risks and in terms of kind of opportunities for this market. Sure. So that having been said, I'll get started. By the way, the webinar is being recorded. This isn't financial advice. It's just general topic of conversation about the state of the New York market of residential multifamily. And if there's any questions afterwards, we're always available, happy to talk. Moving on. I'm Jonah Bamberger. I'm the founder and executive chairman of Aulder Capital. The other partners, of course, are Tzvika Chalami, Shimon Khaldi, managing partners, John Reed and Rob Johnson as partners. On with us today is also Mike DeSenza from our acquisitions team. He's been with us for 3 years and pretty active in the market, and I think he'll be able to give some good color to some of the stuff we're going to be going through. We started Aulder Capital in 2012 in Brooklyn, dealing with rent stabilized housing. Since then, we've grown it out to be a vertically integrated, both in residential real estate as well as hospitality. We've grown outside of just New York, obviously, to cover most of the East Coast. We've done deals in Seattle as well as the Midwest and Louisville, Kentucky. And we have activity in Portugal and an oncoming project in Athens, which is not things necessarily we'll be discussing today. We'll really be focusing on the New York market as a general, kind of from that macro view. So I think the first thing that we need to kind of address when we look at the New York market is kind of the amount of transaction volume that it has slowed. Both in Manhattan and the outer boroughs being Bronx, Brooklyn, Queens, and of course Staten Island. But most of the volume, a large chunk of it is of course Manhattan, because that's the nature of things. And what we've seen over the last quarter, as well as over the last year, is a drop in transaction volume, quarter, pretty significant. And we'll go into more details in the next slide.
Yeah, so one of the things that many brokers that we speak to in the market just kind of continue to preach is the volume just continues to kind of tail off, and a lot of this is kind of geared towards expectations from sellers that are in more distressed situations and having to work out multiple deals that have been purchased over the years. You can see in this chart, which consists of just multifamily volume since 2009. There was obviously a massive ramp up through the kind of zero interest rate period, with volume peaking at $12 billion or so in 2015. And some of these numbers need to be taken with a bit of grain of salt. For example, 2015, there was the Stuytown transaction that BlackRock purchased for $5 billion. So some large transactions can really inflate these numbers. Whereas in more recent years, you're seeing less and less of those large transactions as many investors have started to leave the market for a number of reasons. This particular chart encompasses both the full scope of multifamily supply in New York, which is both obviously the rent stabilized and the free market. We'll dive a little bit more into the rent stabilized volume going forward. But in general, we're starting to see transaction volume drop to 2010 levels, which obviously is, among the lowest in some of New York's history.
So what's interesting about this as well is that it really doesn't reflect pricing at the end of the day. This doesn't address cap rates. It doesn't address price per unit or price per square foot, or any of those types of things. Of course, it's also really for investment products. So we're not talking about apartments or homes, anything like that. This is really for kind of commercial residential product. Obviously, the thing that sticks out the most is the ramp up kind of in the outer boroughs between the 2008 kind of explosion all the way through 2016 before things started to get a bit choppier. In Manhattan as well, where the volume, and it's true that it was definitely large transactions influence significantly, but we can also see the number of transactions with the line bar. And we can see that it was just that there was a certain period of time that it was hot, and then things started to cool off. They started to cool off in terms of transaction volume, certainly before interest rates started to come back up, meaning obviously COVID in 2020, 2021, those are still relatively low numbers compared to what we'd seen historically. 2022, which was really a banner year across the United States in terms of volume, in terms of, kind of the peak of the market. For New York, that 2022 volume, it didn't necessarily reflect, the same number of transactions that were at the same price points that had been kind of in those ramp up years between 2012 to 2015. Us as an organization, we acquired a number of New York properties in 2021 in neighborhoods that, projects like, for those who are familiar, on the Upper East Side in 82nd Street or 84th Street, on the Upper West Side in 93rd Street, and Broadway between 100 and 101. And those were places that previously, if you're looking at that 2013 to 2015 years, cap rates would have been something like a 3% cap rate. We bought it at a much higher cap rate, pricing that sometimes reflected literally half the 50% discount on what it had been previously. Our project in 2647 Broadway, which we acquired for 15 million, had been marketed, I think, in 2016 for 30 million. So while you do see some level of increase in volume in this graph, what you're not seeing is any reflection of price point, which for New York had already been, when we see those highest numbers in terms of growth and volume, that's probably also where you saw the peak in terms of cap rate or any other metric. Later on, of course, that dropped, and what you're seeing, in the last couple of years, in 2023, the numbers that we saw in the previous slide in terms of discounts were for 2024. Then what we're really seeing is, that there's a gap between buyers and sellers. So sellers would rather hold on to projects rather than sell, which it holds true for us as well. And two, that there's that the price point is lower and therefore the volume is lower, of course. In terms of cap rates, and again, I think everybody on this call knows kind of what cap rates are, but we'll keep it kind of clear. So cap rate is kind of the expected unlevered return of the buyers of the market. If people want to buy a project at 5.3 return, but that doesn't reflect a strong enough return for the seller, then the seller, in most cases, can simply not transact. Obviously, a better product has a lower cap rate. In our world, we usually talk about, and I think all of you are familiar with this, A class, B class, C class. And I think that one of the things that we've traditionally seen is that, the better the quality of the asset, obviously, the lower the cap rate is. So when we're talking about falling transaction volumes, frequently what we can see is that those transaction volumes really focus on a certain class of real estate. When retail had its big shakeout a couple of years ago, there was really A-class retail held steady, whereas C-class retail was essentially destroyed and went away, redeveloped or whatever it was. In offices, it's something that's going on today with A-class offices kind of holding value as long as they have a good, strong A-class tenant, whereas B or C-class offices are being repurposed and redeveloped. And we're seeing more and more of that, even in A locations like Midtown Manhattan. When it comes to residential, and when I say residential, I mean multifamily, commercial. We also can see that there's there's a large gap between what would be a C class or what would be an A class. Today, there's a large push for affordable housing, which does fall into this category. There's tax benefits for it. Us as a firm have taken two of our larger assets in New York and repurposed them out of rent stabilized, and we're in the process of converting them to affordable housing, partially because there's larger demand for it on the investor side, and moving them from one asset class being rent stabilized to a more attractive asset class being affordable housing. Then that, for example, will be reflected in the cap rate. Whereas those buyers, rather than searching for a 10 cap, might be more happy with a 6 cap in affordable housing. We have seen some improvement in terms of cap rates. Obviously, there's a question of what debt is available. So for good, strong assets, there's obviously better debt available, stabilized or whatnot. What we've seen in New York, and we don't talk about it too much here, but I'll talk about it anyways. Regional banks, which we'll get to shortly, have withdrawn largely from the market. So there's more kind of bridge lenders or hard money lenders or funds. And there's still activity on the part of Fannie and Freddie to participate or HUD loans, kind of these, institutionals, and they're still giving decent pricing, but lower leverage than what they would have traditionally done. And again, those assets really need to be stabilized or in a better position in order to be able to receive those better debt terms. So again, when you put all of this together, what we're really seeing is a reduction in transaction volume. I think that one of the things that we're also seeing, and this certainly holds true for us as well, when it comes to debt and leverage, I think that buyers are looking for quality. So, and we'll get more into this a bit later. So I think that a lot of long-term players in the New York market that have kind of been through these types of cycles, might be even intergenerational, they're looking for quality at this point, both in terms of location, in terms of the asset quality itself. They're willing to maybe overpay a bit today in order to get the deal done, with understanding that as the market stabilizes, either because interest rates will come down slightly or because people will get used to the new normal and they'll have to transact, that over the course of time, these assets are the ones that have the best potential to overperform. And I think we'll go into that a little bit further in terms of kind of where we see optimism in the market. So I think and to wrap up this section before we dive into rent stabilized, I'd like to talk a little bit about fundamentals. And I think that that's where there's kind of some of that shining light. Mike, do you want to go through this?
Yeah, absolutely. I mean, one of the key components, obviously, for the future of investing in New York is obviously going to be rent growth, as well as job growth and attracting kind of young talent in the workforce and people who are coming in who want to live in New York because they feel it is the best place for them to, whether it's beginning their career and going elsewhere. But it just helps, so many young people, and that's kind of the bedrock of what a lot of the rental demand comes from in New York City. And I think one of the key things, and we'll kind of continue to discuss this even through the rent stabilized aspect, is just the relationship with supply and demand in New York. Supply continues to stay low, and rent growth continues to kind of creep up. And most recently, there's been year-over-year rent growth as much as 8% in the last year in a recent report from Zillow that continues to kind of outpace the wage growth, which kind of just speaks to the tight supply in the market, as well as the continued job growth in New York, where you have so many workers coming to New York and wanting to live in and around New York City. So I think that is one of the biggest kind of components as to, you know, as to the future of New York. And one of the things that this kind of speaks to is the type of investors that are coming into New York and the type of investors that are coming in to invest in New York right now. Bob Knackel, who is obviously one of the most prolific brokers in New York, had recently just said, you know, when the market slows down in New York City, particularly, the first investors who tend to come back into New York and start buying up assets tend to be the high net worth individuals and family offices who have been in New York for years and have been investing and kind of know the market over the long term is going to continue to push. And you know, he mentioned that this is what he's seeing in the market right now. You don't have a lot of funds and kind of institutions investing in New York right now, but you have a lot of high net worth individuals and family offices that are buying low into New York now when no one else is really coming in, because they know that over time that rent growth is going to compound and kind of continue to you know, deliver returns that they've seen, you know, over 10, 20 years throughout their career.
So, I mean, I kind of just want to add on to what Mike is saying, and I agree. And I think that one of the comforts of New York, and I don't know how many of you have been here in the last while, but you know, COVID hit New York pretty hard. Something like 600,000 individuals left the city. Just to get a sense of size, that's the size of Boston living in New York City. New York being a city of 10 million people with a certain amount of growth that the supply side simply can't match the demand, period. So what we're able to see in terms of fundamentals is that there's still a massive talent and people that want to live here, you know, people who rate off New York, you know, be it in the 80s or the 70s or today that's not how it tends to go. Young people want to live here. It's a vibrant city. You know, 3 years after COVID, the streets are full, the tourists are back. You know, by and large, the feeling is pretty good. That having said, in terms of which neighborhoods are on the up and up and which ones are in which position, I think it's definitely true that the prime neighborhoods have enjoyed a lot of that strength. You know, whether it's the feeling of security of walking the streets or kind of where those neighborhoods are more vibrant. There's neighborhoods today that are some of the most, you know, best ones in the city, you know, be it in Brooklyn, like Williamsburg or Prospect Heights, or in Manhattan, neighborhoods that used to be terrible, like Hell's Kitchen, but today are very strong. You know, so we do see that there's been some changes in terms of which neighborhoods are the higher demand, but I think that there's a huge gap between strong demand neighborhoods, again, like Soho or the Upper East Side, and neighborhoods that are just further away or are considered more down and out or more dangerous. And I think that in terms of volume and in terms of pricing, as well as rent, we see huge gaps between one neighborhood and another. Traditionally at Aulder, we've kind of tried to focus on up and coming neighborhoods. In 2021, the deals that we transacted in were because of the price point. You know, we were kind of saying, okay, well, the market's taken a hit, prices are down. Let's bet on these really strong neighborhoods. And really the deals that we did were almost exclusively in the Upper East Side or Upper West Side, which are some of the best neighborhoods in the city. Also in terms of renters, they're just really strong populations, strong retail, work, whatever it is you want. And I think that that's something that's been, for us, really important to, you know, the bets that we're making now are on really strong neighborhoods. I don't know how much up and coming neighborhoods are discounted today, and I don't know how much transaction volume is going towards those. Can kind of feel it in the outer boroughs as well. But certainly if we're going to look at good product and kind of go for the best of the best, that starts with location, and there's no question about it. Now we're going to get into a discussion, I think, a little bit about rent stabilization and kind of what that's done to the markets to some extent. Obviously, previously Alder, that's where Alder started. We started in the rent stabilized section. We have some legacy assets that we've been fighting over since then. And without a question, this asset class has taken a massive hit. The 2019 Rent Regulations Act, which is, again, it's from New York State, but it primarily affects New York City, was dramatic in terms of the ability to raise rents, in terms of how to turn units. Units that previously you could take them free market, that was no longer the case. Now a unit that's rent stabilized, it's always rent stabilized. A huge part, maybe the biggest part of our investment strategy was what was called individual apartment improvements, which was essentially taking an apartment and increasing the rent through investing in that unit and really making the pricing pop. The second that regulation disallowed that, it meant that an $800 unit is an $800 unit. But at that point, there's no return on investment for putting a $20,000 or $30,000 renovation in. In the most extreme cases, those units just have to sit vacant. Now, previously, or up until recently, there was a couple of kind of loopholes to that, whereas if you restructured apartments or combine them or change the configuration, you could kind of get around that. So you would leave units vacant with the hope that you could do an adjacent unit as well and kind of get through that work. And we did a couple of those, but even that at this point has been tightened up. And what it means is that there's units simply offline. Buildings with rent stabilization, the average unit price is down 34%. Non-regular apartments pricing can be up. That depends again, because there's buildings that can be half rent stabilized and half free market, and so on. The Rent Stabilization Act, not only was it extended, we didn't get too much into it here, and it will continue to be extended. But recently there was also a law called Good Cause Eviction that was passed. Some of the details are still being hammered out, but essentially it puts rent stabilization on free market units of certain vintages as well. And I think that that's something that we as a firm are still struggling to get our heads wrapped around. In many cases, we feel like it's not necessarily a dramatic law. The question is kind of how investors will look at it. And certainly there will be a flight of capital to cities and states that are simply less regulated.
Yeah, I think to expand on that point about good cause, it becomes a very situational. The law is very situational and kind of dependent on the type of building you are looking at and how long the tenants have necessarily been in there. I think there's considerable risk for certain unit types that don't necessarily get natural turnover. So if you have long-term tenants in a building or in a particular unit that is likely rented under market, perhaps I would say the risk falls with buildings that have been in families for long periods of time, 20 plus years, that have renters that they've been renting to for 10 plus years, and they've kind of been on a friends and family deal for a while. For an investor to come in and purchase buildings with that type of exposure leaves you it has a considerable amount of risk with good cause eviction, whereas some smaller buildings or buildings with smaller units that might deliver some type of natural turnover, there's less risk involved with the good cause eviction.
Of course, one of the things, especially in rent stabilization, that really we kind of felt the ways through the markets were in the capital markets, particularly with regional banks. Signature Bank, as some of you might be aware, was confiscated essentially by FDIC, by the federal government a couple of years ago. They had, I believe, $11 billion worth of rent stabilized loans on their books that are being sold off in chunks at 64% of loan value. That is partially a reflection of to some extent of interest rates and at which interest rates those loans were provided. They were not in default at the time. It's kind of a combination of a large institution together with nonprofits that have done some of those deals. But it's also a reflection of just kind of the amount of write-offs that they intend to do on that portfolio. We know that now that they're working it out, they've been pretty aggressive in terms of taking over properties themselves and kind of those fundamentals. So it's not just about necessarily working things out the way that a normal bank would do. The people that took over that Signature Bank portfolio, a lot of times it's to take over the real estate itself. NYCB, whose stock price has been on a bit of a roller coaster, was a large lender. We've done some work with them as well, and they've got a significant exposure to this sector as well. What it means primarily, they seem to be able to work it out. They brought in $1 billion worth of capitalization to shore up their balance sheet. What I think this means for us at the end of the day is that when we look at this type of product, these regional banks, until they can work out the distress in their portfolio, are not necessarily lending unless it's a really, really strong property to a client that they have an existing relationship with. And of course, less debt options and terms that are more egregious are also reflected in cap rates and therefore, of course, in deal volume. So when you don't have enough capital market players in the market, then of course that will impact deal volume as well. And it's something that we've been really on top of. Just to kind of wrap up what some of these things means in terms of actual properties and and again, every property has its own experience. But if we're talking about over the last couple of years, really limited growth in terms of there was about 3 years in a row of zero growth in terms of ability to raise rents by the rent guideline boards. More recently, they think that they have been more generous to landlords, but in a year where there's 8% inflation to allow landlords to increase rents by 2% or 3%, well, at the end of the day, that simply doesn't cut it. We've seen properties, and this is, these are kind of numbers across the board. So again, it's not necessarily a reflection of our properties, but between 20 to 24, insurance went up 224%. That's something that's New York took a big hit on, not nearly as big as other locations or more coastal or more prone to hurricanes like Florida, where those numbers can be even double those numbers. Real estate taxes, of course, gone up significantly, and utilities in general, water and sewer, and gas prices for heating. Although winters have been more mild, the price for those utilities have gone up significantly. And what it means is that landlords are being kind of squeezed on both sides. Higher non-controllable expenses, as well as less of an ability to raise rents. And that's put a significant number of assets in distress. It's crunched on their net operating income. And of course, regardless of what the cap rate in the market is, that's what at the end of the day drives volume. The value of the property is that net operating income. So you kind of take, in terms of what's going on in the market, on the downside, we've got a reduced net operating income for these types of assets. We've got less debt available and more expensive when it is available. And of course, that impacts transaction volume and pricing.
And just briefly to touch on the insurance costs, a lot of the underwriting for rent stabilized specifically is becoming a tighter and tighter market. There are a lot of carriers who are simply no longer even writing policies for these type of assets. So it's a kind of a double-edged sword on the debt front, where you have lenders who are pulling back significantly and a lot of lenders who are just completely out of the market on rent stabilized, as well as insurers who are recognizing that there's a capital shortage for this asset class, which means that the insurance premiums are going to have to increase as a result, because a lot of landlords may or may not have the capitalization they need to actually feed these assets, which at the end of the day, become a more difficult asset to manage and receive more wear and tear at the end of the day.
Absolutely. Of course, this is reflected in transaction volume. Again, you can kind of see the peak years, 2015 14, 15, 16, all the way through 18. And then, of course, the transaction volume with the Rent Regulation Act of 2019, it dropped pretty significantly. I think that there's been some recovery in transaction volume for rent stabilized buildings, but it's primarily a question of, buyers giving up and kind of distress and saying, okay, well, time to move on. So again, this doesn't necessarily reflect the price point that everybody's transacting at. And we'll give some examples in terms of some recent transactions. These are all large organizations playing in the rent stabilized space. Again, not the BlackRocks, not the real huge deals, but if it's Centennial Real Estate, sold 1,300 apartments across 24 properties, 40% discount from 300 million down to 180. Just so everybody on this call can understand, that means that the lenders at the time were giving about 70% financing. So a 40% discount means the lenders also had to give up some of their stake. That means that the investment in equity that was made by a group like this is the equity is wiped out. The lender takes the hit, and it also means that the new buyer sees that from their perspective, there's some level of opportunity at this new price point. I think in terms of, and I'll touch again a bit, some of our investors are Israeli. In Israel, there was a lot of press around HAP, which, some of these deals reflected there as well as another firm that I think they had $100 million worth of deals that were sold for 40 million at the end of the day. So 60% discount on the price, which means that the equity, of course, had been taken out. So we can kind of see that there's different, there are transactions. This is what they look like, and the banks are aware of this, which is why they're pretty cagey by and large, about taking the asset back. And of course, to kind of end up with, kind of what that means for us as a firm and as investors, the bright side of this, of course, is that at the end of the day, when you look at rent growth and supply, specifically in New York, but also across these types of assets in other large cities that have kind of taken a hit, the fundamentals are really strong. The lack of supply is reflected in really strong rent growth. Other cities where we see that it's been overbuilt or their rents have really come up too high, they have their own challenges coming up in terms of that. So some of the cities that have kind of had the highest amount of increase in supply are also the ones that are taking the largest hit in terms of year-over-year rent growth. Previously, there might have been a real increase in rent growth, certainly around COVID, as people left, some cities like New York to go to further south, to Florida, to Texas, where there was different regulations. But I think we're seeing that's not necessarily something that's been sustained. And certainly in terms of the supply that was built, there's simply oversupply. And what we're seeing in New York specifically is that the lack of supply combined with the tight demand means an increase in rents. By the way, this is across New York City, what we're seeing here. So it includes rent stabilized units, but it also, which are of course lower than this, but it also means that in certain neighborhoods, this numbers could be much higher. I think Mike mentioned that in certain asset classes can be as high as 8%. I know for us as a firm, the post-COVID, in 2020, 2021, we had to give these huge discounts, 3 months rent for free, 20% discount to tenants to come in. 2022, 2023, all that went away, and we've seen significant increase in rents. Again, especially for better product, because that's what people are looking for. People who are making more money, young professionals, they might even be okay with a roommate, but what they're looking for is a certain level of quality. And that's not something they're necessarily willing to compromise on. Quality, of course, being in terms of location, but also in terms of building amenities and quality of the unit itself. So, when we look at the macro numbers, we're seeing really positive fundamentals for rent growth in New York. And what's at the end of the day, from all we've gone through, is historical, discounts in terms of pricing. So kind of to wrap it up, and thank you for your patience and time. If you believe in the city of New York, which we do at this firm, then we may be in a position to a historic opportunity to buy. It requires patience. It requires being picky. It requires strong relationships with lenders because of the challenges in that environment. But even as interest rates start to come down or even out a bit, and money starts to flow back in, there's certain organizations I think that'll be very shy around New York, but the fundamentals of the market are substantial. Everything continues to point to a lack of supply, strong demand. Where New York has lost some jobs in terms of finance, it has certainly made them up in terms of high tech. It continues to be one of the second or third largest high tech hub in the United States, and that's not a surprise because young people would rather live in New York City than in an up and coming market like Research Triangle in North Carolina. It's just New York is still New York. It still has that energy. And that's something that we believe will continue. So we think the fundamentals are strong. We think that there's opportunities they may not be ripe today, but they will be up and coming. And again, it'll need to be something and that's where I think to wrap it up, quality is going to be the name of the game. It won't be a kid in a candy store where everything wins. It really needs to be the right asset and the right location at the right price. But we think that there might be really strong opportunities to together with some patience to really make something interesting happen. And that about wraps it up. Mike, is there anything you want to come back with, or?
No, I think that's good. And I mean, as far as on the supply front, I think one of the other key components is obviously the elimination of the 421A. Interest rates are up substantially, and particularly in the construction lending, it's become more and more difficult, and these lenders are requiring more and more capital to be put up front. And obviously, there's a lot of discussion of rate cuts in the future, and I think even with 150 to 200 basis point reduction in rates, I don't necessarily think that helps these builders go out there and just start producing units. I think they need a significant change in the wind in order to ramp up significantly to start constructing units.
That's certainly, I think, 421A, by the way, for everybody on the call, it's a tax abatement program for new construction, which there's a new program being put into place, which is problematic. But I think that everybody's kind of pointing to the same direction, that in a city of 10 million people, you need a certain volume in order to keep up with demand. And that there's no real possibility of that happening. So even if pricing is historically low today, we think that the fundamentals are strong. New construction has been, and will continue to be very limited. And even then, it really only pencils either in the affordable housing where you get significant tax subsidies, or in the luxury section. So it kind of leaves that whole middle market open with even tighter supply, which is kind of where we're able to drive rents. And I think that's certainly part of the long-term story and long-term strategies of New York. So again, thank you everybody for your time. We're always available for individual conversations. We're happy you joined us on this webinar, and we'll see you on the next one. Thank you.